Something is quietly happening in Singapore's construction steel market, and almost nobody is talking about it. A company backed by Chinese interests has spent the last 18 months buying up not one, but two of the biggest steel businesses listed on the SGX. They now control the supply chain that feeds some of Singapore's biggest construction projects. Changi Airport Terminal 5, the new MRT lines, tens of thousands of HDB flats. The company they just took over? It's called HG Metal, ticker BTG on the SGX. It's not a name most retail investors know, but after today, you will. And here's the thing. Buried inside this company is something really interesting from a pure investment standpoint. 85 million Singapore dollars in cash. On a company with a 150 million Singapore dollar market cap. That means 53 cents of every dollar you pay for the stock is just cash sitting in the bank. So today we're going to break down exactly what HG Metal does, why a Chinese-linked entity just took it over, what that means for Singapore's steel prices going forward, and whether this stock is actually worth looking at. Let's get into it. First, what does HG Metal actually do? Imagine you're building an HDB block. You need thousands of tons of steel, rebar for the concrete, steel beams for the structure, plates, pipes, channels, all kinds of shapes and sizes. You don't call a mill in China and order yourself. The quantities are too small, the logistics too complicated, and you need it delivered just in time to your construction site. So you call HG Metal. HG Metal sits right in the middle of Singapore's construction steel supply chain. They buy steel in bulk from mills in China, Japan, Korea, Turkey, wherever they can get it cheapest. They store it in their massive 500,000 square foot warehouse in Jalan Bureau, and they sell it to over 1,500 customers across Singapore, Malaysia, and Indonesia. They have three main business lines. First, HG Distribution. This is the core. They stock over 3,000 different steel products, everything from small angle bars to massive structural beams. If you need steel in Singapore, there's a good chance HG Metal has on the shelf. Second, HG Construction Steel. This is the value-add part. They don't just sell steel. They cut it, bend it, shape it exactly to spec for your construction project. They have a 100,000 ton per year processing capacity in Singapore alone. Third, HG Coupler and Thread. This is the specialist niche. For high-rise buildings and major infrastructure, they supply the mechanical connectors that join rebar together. Higher margin, lower volume. The business model is simple. Buy low from mills, add value through processing and logistics, sell high to contractors. The margin is a spread between what they pay and what they charge, plus the processing fees. When steel prices rise and HG Metal has older, cheaper stock, margins expand. When prices fall and they're sitting on expensive inventory, margins get squeezed. That's the core earnings risk of this business. Now, let's look at the financials, because this is where it gets interesting. Revenue has been all over the place. 92 million Singapore dollars in 2020 during COVID. 158 million Singapore dollars in 2022 when steel prices spiked. Back down to 130 million Singapore dollars in the 9 months to September 2025. That volatility isn't a business problem. It's just how steel distribution works. You're a price taker. When global steel prices move, your revenue moves with them. But here's what I find more interesting: gross margins. In 2021, margins hit 20.5%. Incredible for a distributor. That was because COVID stimulus created a steel price surge, and HG Metal was sitting on cheap old inventory. Then in 2023, margins collapsed to 8.6%. Steel prices had fallen, and they were selling expensive stock at cheap prices. But look at the most recent number. In the first half of FY 2026, October 2025 to March 2026, gross margin was 17.1%, best in years. Why? Because China has been dumping steel onto global markets. 119 million tons of exports in 2025 alone. That's kept HG Metal's purchase costs low. And Singapore selling prices haven't fallen as fast. So in the short term, the China oversupply is actually helping HG Metal's margins. But the real story is the balance sheet. 3 years ago, HG Metal had 35 million Singapore dollars in bank borrowings and was losing money. Myanmar operations had blown up. Management wrote off 9.8 million Singapore dollars and walked away. Today, 85 million Singapore dollars in cash and deposits. Only 5 million Singapore dollars in debt. Net cash of around 80 million Singapore dollars. On a company worth 150 million Singapore dollars in the market. That means if you buy the stock today, 53% of what you're paying is just cash. The actual operating business, 40-plus years of steel distribution, warehouse infrastructure, 1,500 clients. You're getting it for about 70 million Singapore dollars. Is that cheap? Let's come back to that in the valuation section. Okay, now the part you came for. Who is actually behind this takeover? Slide, Green as Steel corporate structure diagram. The acquirer is called Green as Steel Pte Limited, Singapore registered, investment holding company. But here's the picture when you pull back the curtain. Green as Steel already owns 61% of BRC Asia, the biggest rebar fabricator in Singapore. You've probably seen their trucks on construction sites. They supply about 60% of Singapore's rebar market. In late 2024, Green as Steel triggered a rights issue at HG Metal. Shares issued at a big discount, which diluted existing shareholders enough to give Green as Steel a route to majority control. By February 2025, the mandatory general offer closed. Green as Steel now owns 52.6% of HG Metal. So Green as Steel now controls both of Singapore's dominant construction steel companies, the biggest rebar fabricator, the biggest steel stockist, under one roof. And it doesn't stop there. Green as Steel also controls Antara steel mills in Labuan, Malaysia, produces hot briquette iron, which is a key raw material for making steel. They have a 2.5 million ton per year HBI plant in Sipitang, Malaysia. They're building a brand new electric arc furnace steel mill in Johor called Eden Flame, targeting to open in Q3 2026. 500,000 tons of annual rebar capacity, low carbon steel. And through BRC Asia, they just acquired a controlling stake in Southern Steel in Malaysia. So the picture you're seeing is a vertically integrated steel supply chain, from raw materials all the way to finished steel delivered to your construction site, all under one owner. Now, who ultimately owns Green as Steel? The CEO of HG Metal is a woman named Xiao Xia. She has a degree from East China University of Science and Technology and past directorships in Shanghai-based energy and commodity companies. The S-Steel and Emetal branding also suggests Chinese commodity trading networks. But here's what I need to be transparent about. Green S-Steel is not a confirmed Chinese state-owned enterprise. It has Japanese backing too. Hanwha, one of Japan's major trading houses, has invested in Green S-Steel and secured sales rights for their HBI production. So it's a Chinese-connected, Japanese-partnered, Singapore-registered entity that now controls the backbone of Singapore's construction steel supply. The exact ownership structure isn't fully public. Singapore's Competition Commission, the CCCS, reviewed this acquisition and cleared it, so regulators are comfortable. But it's a striking level of consolidation for a city-state that imports almost all its steel. This is the question I know a lot of you are thinking about. If one entity controls most of Singapore's construction steel supply chain, can they jack up prices? Short answer, not easily. And here's why. Singapore has no anti-dumping tariffs on steel imports. Unlike the US, the EU, or India, Singapore's market is completely open. If BRC Asia and HG Metal try to raise rebar prices above the global market rate, construction companies could just import steel directly from Chinese mills. China exported 119 million tons of steel in 2025, a record. Their domestic property market is in crisis, and they need somewhere to sell. Singapore is a willing buyer. So in the short term, steel prices in Singapore are being held down by Chinese oversupply, not pushed up by consolidation. Short term, deflationary. Medium term, stable to modestly firmer. Long term, the green steel premium is the wild card. Here's the long game that Green S-Steel is playing. Singapore has a carbon tax that's rising to 50 Singapore dollars to 80 Singapore dollars per ton of CO2 by 2030. Steel made in a traditional blast furnace, the kind most Chinese mills use, has a very high carbon footprint. Steel made in an electric arc furnace, like the Eden Flame Mill being built in Johor, has about 50 to 75% lower carbon emissions. As Singapore's green procurement rules tighten, builders may have to source low-carbon steel to get building approvals or avoid carbon taxes passing through their supply chain. And who will have that low-carbon steel ready to sell in Singapore? Green A Steel. That's the moat they're building. It's not about raising prices today. It's about owning the green supply chain when the regulation forces everyone to care. Okay, investment case time. I want to be upfront here. I run this channel from the perspective of building financial independence with real money and real analysis. I'm not a licensed financial advisor. This is my research and my thinking. You need to do your own due diligence. With that said, let me walk you through how I think about HG Metals valuation. Start with the balance sheet. Market cap is roughly 150 million Singapore dollars. At the current share price, around 0.545 Singapore dollars. Net cash minus debt, is about 80 million Singapore dollars. So the enterprise value, what you're actually paying for the operating business, is only about 70 million Singapore dollars. Now earnings. My base case forecast for FY 2026, which runs October 2025 to September 2026, is earnings per share of around 0.064 Singapore dollars. That puts the PE on the operating business at roughly 8x when you strip out the cash. For context, BRC Asia, the sister company under Green A Steel, trades at 12 to 13 times earnings. U.S. steel distributors like Reliance Steel trade at 14x. HG Metal at 8x x cash is cheap on that basis. When I run a discounted cash flow, using conservative growth assumptions and a 9.5% discount rate, I get a fair value of around 80 cents per share. Against the current price of 0.545 Singapore dollars, that a margin of safety of about 32%. My verdict, pass monitor. The stock looks undervalued at 0.545 Singapore dollars. But there are real risks I want to see resolved before I take a full position. What are those risks? Risk 1. Related party transactions. Green A Steel controls HG Metal and BRC Asia, and the new Eden Flame Steel Mill. Will HG Metal be forced to buy steel from its sister companies at above market prices? That would destroy the margin advantage for minority shareholders like us. Risk 2. China steel oversupply. The margin expansion HG Metal is enjoying right now comes from cheap Chinese imports. If Chinese steel prices recover, which rebar futures are starting to suggest in May 2026, those margins could compress again. Risk 3. Governance. The rights issue that let Green A Steel take over was issued at 13 cents per share, a massive discount. Existing minority shareholders got heavily diluted. Will management align with minority shareholders going forward, or with the controlling parent? The thing that makes me cautiously positive despite those risks? That 80 million Singapore dollar cash pile. Even in a bear case where earnings disappoint, the cash on the balance sheet is a massive floor. You have to destroy a lot of value before the stock genuinely becomes cheap in the wrong way. So, let me bring this all together. HG Metal is a 40-year-old Singapore steel distributor that most retail investors have never heard of. It's been through a rough few years. Losses, a failed Myanmar expansion, management changes. But now it's profitable again. The balance sheet is fortress strong, and it's been quietly absorbed into what has become the most vertically integrated steel supply chain in Southeast Asia. The Chinese-connected parent company, Green A Steel, now controls both HG Metal and BRC Asia. That's a duopoly over Singapore's construction steel market. Not technically illegal, the regulator cleared it, but a remarkable concentration in a market this small. For steel prices in Singapore, probably neutral to mildly positive in the medium term. The green steel angle could be a real premium catalyst from 2027 onwards as Singapore's carbon tax bites. For the stock, I think there's about 30% upside to fair value from here. But I want to see more transparency on related party transactions before I go all in. This is on my watch list, not in my portfolio yet. But it's one of the more interesting small cap situations I've come across on the SGX this year. If you want the full institutional grade deep dive, DCF, forensic accounting analysis, 15 questions for the CEO, and a complete supply chain map, I've done all of that research and it's linked in the description. As always, do your own research. I'm sharing my thinking, not telling you what to buy. If you found this useful, hit subscribe. I'm building toward financial independence in Singapore and posting the honest, no BS version of that journey. New video every week. See you in the next one.